You're hitting on a fundamental concept in how stock prices are determined: supply and demand. When the seller is greater than the bidder in the stock market, it means there is more selling pressure than buying pressure at the current price levels. Here's what that generally implies and how it impacts stock prices. 1. Supply exceeds demand. Bidders, buyers. These are individuals or institutions willing to buy shares at certain prices, the bid price. The highest bid is the most someone is willing to pay. Sellers, askers. These are individuals or institutions willing to sell shares at certain prices, the ask or offer price. The lowest ask is the least someone is willing to accept. If there are more sellers than buyers, it means that at the current price, there are more people wanting to get rid of their shares than there are people willing to acquire them. 2. Downward pressure on price. Sellers lower prices. To find buyers, sellers will have to lower their asking prices. Imagine a market where many people are selling apples, but few people want to buy them. The apple sellers will have to drop their prices to attract buyers. The same applies to stocks. Buyers become more demanding. With an abundance of supply, buyers have more leverage. They will tend to bid lower prices, knowing that sellers are eager to offload their shares. This continuous interaction of sellers lowering their prices and buyers being more selective at lower prices drives the stock price down. 3. Wider bid-ask spread. The bid-ask spread is the difference between the highest price a buyer is willing to pay, bid, and the lowest price a seller is willing to accept, ask. When sellers outnumber buyers, the bid-ask spread tends to widen. Sellers may drop their asking prices, and buyers may drop their bidding prices, creating a larger gap between the two. A wider spread often indicates lower liquidity. 4. Market depth changes. The order book or market depth shows the volume of buy and sell orders at various price levels. If sellers are greater than bidders, you'll see a larger volume of sell orders, asks, at current or slightly lower prices, and a smaller volume of buy orders, bids, at current or slightly higher prices. This imbalance in the order book signals downward pressure. In the context of UBS SEC selling -192,940 shares of JFC, this large sell order, if it's a net sell, indicates that UBS SEC is introducing a significant amount of supply into the market for JFC. If there isn't sufficient demand from buyers to absorb these shares at the current price, 226.0, then the price will likely drop as UBS SEC, or other sellers, tries to find willing buyers at lower price points. The extent of the drop depends on the depth of the buying interest below 226.0. If there are many buyers waiting with limit orders at 225, 224, etc., the drop might be gradual. However, if there's a lack of buying interest, the price could drop more sharply. Therefore, yes, if the volume of shares sellers are willing to sell, supply, is consistently greater than the volume of shares buyers are willing to purchase, demand at current price levels, the stock price is highly likely to drop. The question then becomes how far and how fast, which depends on the magnitude of the imbalance and the overall market sentiment.